Section 199A is the QBI deduction. It's an income tax deduction of up to 20% for owners of most pass-through businesses. It does not reduce self-employment tax, and you can claim it whether you itemize or take the standard deduction. On the EA exam, they love that contrast. Deduction, yes. Payroll tax savings, no. Start with who can claim it. The deduction is for pass-through owners, sole proprietors, partners, S-corp shareholders, and certain trust or estate beneficiaries. It's determined at the entity level, but claimed on the individual return. A C corporation's income is not eligible. Also, it's generally for domestic business income, so you may need to allocate U.S. versus foreign activity. The deduction has two components. First is the QBI component, 20% of qualified business income from a qualified domestic trade or business. Second is the REIT PTP component, 20% of qualified REIT dividends plus qualified publicly traded partnership income. Exam tip: don't mash these together. They're computed separately, then combined, and both still live under Section 199A. Now define QBI. QBI is net items of income, gain, deduction, and loss from a domestic trade or business that are included in taxable income. It can include rental income if the rental rises to a trade or business. But QBI does not include W-2 wages as an employee, capital gains, interest and dividends, tax-exempt income, hobby income, or guaranteed payments to partners. Those exclusions show up constantly on exam questions. The basic computation starts simple. Tentative deduction is 20% of QBI, but it can't exceed 20% of taxable income minus net capital gain, and the threshold concept matters. If taxable income is below the threshold, the calculation is generally straightforward. Once you're above the threshold, wage and property limits can apply, and for SSTBs, the deduction can phase out entirely. For 2024 thresholds, memorize the idea more than the exact dollars, but know the numbers can be tested. Married filing joint has a threshold range of $383,900 to $483,900. All other filing statuses, $191,950 to $241,950. Below the threshold, you usually don't worry about W-2 wages and UBIA limits. Above it, those limits can cap the deduction hard. Mechanically, you claim the deduction on Form 8995 or 8995A, then it flows to Form 1040 or 1040NR. Partnerships and S-corp report your QBI-related data on Schedule K-1 using specific codes. If the entity doesn't provide the required QBI info, the regulations let the IRS treat QBI as zero. And if you have a qualified business loss, you get no deduction this year. The loss carries forward for 199A purposes only. Does a taxpayer have to materially participate in a business to qualify for the QBI deduction? The options include: material participation is not required if a 250-hour safe harbor is met. Material participation is required. It's only required for sole proprietors, or it's not required at all. Think about what Section 199A actually asks for. Think about it. The correct answer is no. Material participation is not required for the QBI deduction. Section 199A is based on having qualified business income from a qualified trade or business, not on the passive activity rules. A tempting wrong choice is the one mentioning a 250-hour safe harbor, because that relates to certain rental guidance, but it's not a general material participation requirement for 199A. Marisol is a self-employed veterinarian, single, with $275,500 of net Schedule C income. After adjustments, her modified taxable income is $235,258. Her business is a specified service trade or business. What is her Section 199A deduction for 2023? The choices include zero or amounts around $50,000 to $55,000. Think about the SSTB rule and the income thresholds. Think about it. The correct answer is 0. Because her business is an SSTB and her modified taxable income is above the full SSTB phase-out range for her filing status in 2023, the deduction is completely disallowed. The tempting wrong answer is 20% of her business income, because that's the basic rule, but SSTBs lose the deduction once you're over the top of the phase-out.